Hey guys, welcome back. Took a day off. Sorry, I was a little bit under the weather, but very pleased. It seems like we do these quarterly now with our main guy Cookie over here. Guys, welcome back. I got some feedback on the YouTube there, but thanks, Cookie. Thanks for joining us. GP's here. I'm not sure since it's an intraday thing if Nick's gonna be able to make it, but hey, Cookie, last time we talked to you was in June. It was before my exodus across the country. And the market was in a very similar spot. So the more things have changed, the more they've stayed the same to some degree.
Yeah, funny that. What a coincidence, no? Well, I mean, you want me to talk about that? I'm not.
Sure.
I don't think it's a great thing that we're in the same place as we were.
No, I don't either.
It would be nice if this call had taken place two or 3 weeks ago when we were a couple of 100 points higher. But as far as being in the same place is concerned, the trends are they're deteriorating, right? So I mean, I use moving averages as some of you guys do as well. And with prices going sideways, moving averages flatten out and risk rolling over, which is what's happened over the last 2 or 3 months. So even though we might be in the same similar price levels to where we were in June, the trends look worse. And we can talk a little bit about that.
Yeah. I think, when we had you on, it was the middle or late June. We had a July reversal. It was somewhere in this area. And we ripped to the upside for, a month and a half and now rolling over. GP, I know you've been watching Netflix as sort of your canary in the coal mine. It's been performing pretty well. But I think the indexes as a whole, you're probably not satisfied from the price action you're seeing either.
Indexes, no, but Netflix is up 50% from the bottom. So I'm happy with that performance. I think I'm gonna let Cookie do a lot of the talking because it sounds like he's eager to share a bunch of charts. I hear you on the trend changes and it's not looking great, but there's a few things that I see that just don't make any sense.
Let's get into it. What doesn't make sense to you? And maybe Cookie, if you want to take over sharing, I can let you do some of that too, but I'm happy to drive. Just let me know.
Okay, sounds good. And hey, let me just say, GP and Bagsy as well, that I'm just another participant on this call, so I'm not the star, and I value much a lot of what you guys say. So I think the more of us who participate, the better. So I just want to say that
you got it. We won't leave you on an island.
Yeah, definitely not Cookie, but we do this every week, so people hear our nonsense all the time.
Okay, that sounds good. Okay, so I'm going to share my screen. That's what we've got. So before I do, what I thought we could do today is I want to show you how much the market is still in the balance, and that things could still change this week. And we've seen how like the inflation data last week, or whenever it was, it seems like such a long time ago, but last week it absolutely destroyed the market in about 2 hours. And so I'm always open to things changing at any moment, even though the trends are pretty clear and they look a little bit rough. Things can change, which could upend everything. So I'm open to that. And I think, this week's going to be important again, and then we'll have all the discussions about whether it's going to be, 75 basis points or 100 or 50, or what's it going to say afterwards. So I think we've got to remain open to anything changing. And what I'll share with you then on the charts is a couple of things. Number one is how I see the trends looking long term. So we'll take another. So I want to share my charts, which, monthly charts, which go back 10, 12 years. So we can take a look at a few of those different sectors. And then also I want to talk about the price action that we're seeing leading up to the FOMC meeting as well, or to the rate announcement.
I've stopped sharing. If you want to turn yours on, you can.
Because let me share screen. Desktop. Okay, so you should be able to see that. This is just my watch list for now, but I'll share a couple of charts in a second. So the point being, and I think you probably experienced this as well, and I think most of the people on the call have done too, which is the market is incredibly hard to read. And there's one thing in like the macro and the data and the environment and the war in Ukraine and the price of oil and all these things. But intraday, or even from day to day, things change so, things are so erratic, and it's leaving many people very confused. So they might have an idea as to where, what they think the market should do based on what they're reading and what's going on in the world, but then things completely different happen. And what I want to try and share with you during the call today, remind you if I forget, is that it's all a complete circus. And I mean that lovingly, because I love the market, right? I mean, it's my life, but it's all orchestrated to the second. So it's not just to the price point, but to the second across every instrument, whether that's crypto, commodities, currencies. It's all connected and it's all orchestrated. And hopefully I'm going to be able to share why I think that using a couple of those charts, and why that might help us understand what might happen in the next 2 or 3 days, and maybe what happens coming out of the Fed meeting as well. It might already be in the charts. That's what I'm going to try and say. So if that sounds like an interesting agenda, we can get started on that.
Yeah, let's do it.
Okay, right. So first off, the S&P. Now, so what I'm going to share with you here, first of all, is, so this looks like a very simple chart. So it's on a log scale. This is a chart that goes back to 2008. So it's got the 2008 financial crisis or the recession there as well. And it's got a couple of other periods marked, including 2015, where the market went sideways for a year, and currently where we are right now. Now, about early August, I think it might have been, I shared this chart, which is the same thing, but for XBI. So this is biotech. And what I've done is I've created one chart which all of them follow, everything, every sector. And it's not just the market sectors, but it's also crypto as well. So, I mean, we'll come back to this in a second, but, oh, not that one. That's Bitcoin on the same chart. That's Ethereum on the same chart. Soxel on the same chart. But I want to go through this because it's an interesting exercise, because what it does is it allows us to compare and contrast different sectors in the market with what's going on with the S&P as well. And it also shows us how much of a crossroads we're currently in, despite how negative everything looks. So for example, so these pivots have been there since the beginning of the month, marking up the pivots for September. And you can see how 383.43 is the pivot and 384 is the current price. So it hasn't died yet. But what we can see is that as far as the trends are concerned, we're below a falling 9 monthly moving average. The 20 monthly moving average is flattening, but it's still rising. So it isn't dead yet. But price is holding so far. So the fact that we got to this point at this moment in time isn't a fluke of nature. I mean, you'll find that, if you spend as much time as I do charting, then you see how price gravitates or moves to certain places or spaces on charts at given moments in time. I'm sure, GP, you've seen that many times, whether it's looking at patterns for Netflix or other things. You'll see how price goes to a certain spot in the chart on time. And that's not just natural buyers and sellers coming together and deciding to buy and sell a bunch of shares. I think there's a lot more to it than that. And maybe that's a discussion for another call. But anyway, for now, what the chart shows me is, well, deteriorating trend. So you're seeing, a price, as I mentioned, below weakening monthly moving averages. Now, what you see here is the moving averages crossed over, right? So you see the 9 below the 20, and what happened over the last 2 months, and this is perfect, right? So if I zoom in a little bit, I should say, you can see, so we broke out in the month of August. So that was the move higher. We reached the crossing moving averages, and that often happens. So when moving averages are about to cross, price will move towards them, say hello, and then either pushes through or it gets rejected there. So that was very technical, and it happened on time, because the moving averages will cross at a certain time, right? The pullback from there, and then the market heads down. And then this month, so this is the September candle, we rejected the 9 monthly moving average again, which is interesting, right? Because that's not what you want to see. Now, before that happened, so before the move down, we were already below a 20 and a 9 weekly moving average. So the trends on the weekly chart were already looking a little rough. But then we went back and rejected the monthly moving average, which is bad, because if you look back at all these previous corrections, first of all, it's not common to see crossing moving averages on the SPY. You don't see that. Go back and you take a look at 2020. The move back was so quick, as quick as the move down, that they never came together, let alone cross. And if you look at 2019, the same happened again. So at the end of around Christmas 2018, you had that the market dropped 2,400 or so, and then it reversed back in January. And again, they came together, but they never crossed. So there was these two corrections in recent memory, right, which were violent, very fast, but didn't affect the trend. So this time is different, at least compared to these two. So then we go further back and we look at other examples. And you look at, an example where they do cross, and this is going back to 2015 and 2016. So this is Brexit, Trump election, all that rubbish in the news, right? I mean, it was mess for a couple of years, not unlike the market that we're seeing today. There's a lot of noise, there's a lot of fear. What is going to happen to the European banks? What's going to happen to Greece? What's going to happen to the UK? And so, it's interesting how, there's just so much fear and noise and FUD and everything just happening right now. And it's similar to the time over here. And you had the elections and the run up to Clinton and Trump election over here as well. So there's a lot of noise and a lot of things happening which are similar to that. So you could say, well, maybe this could end up looking something like that. And as far as I'm concerned, that would be the best case outcome. That would be the best case outcome. In other words, we don't die, but we go sideways whilst the moving averages eventually, price finds support. Because I mean, right now we're finding support above the June lows. We haven't broken the June lows yet. I mean, we could, and that might happen this week. Who knows, right? We're not that far away, but we're still above the June lows. Over here, we came down and retested the lows from a year earlier or 6 months earlier, not unlike what we're seeing over here. So if this area holds, then the market could morph into a period that looks something like the period running up to the elections back then. And we've got midterms coming up here as well. So there's a lot of similarities in this period over here compared to what we had 2015 and 2016. We're also above the rising 50 monthly moving average, just as we are over here. So the market isn't dead yet. And I think what might happen over the next couple of weeks could decide whether it does die or not. So I'm keeping an open mind for now. And as you can see, that there was all the opportunity in the world for the market to die this morning, but it didn't. Right? I mean, overnight, the market was down nearly 1%. The futures were down nearly 1%. All the sectors were down. And then the market went higher as the markets went higher as the bell rang, right? And they just raced higher. And now they just stalled at the pivot, pretty much at this level over here. So again, it's all being held together, and it's not because of all the buyers and sellers coming together. I think there's something a little bit deeper than that. But the fact that it's still here leaves the door open. Now, there's another case as well. So we've got the case where the moving averages don't cross. We've got a case where they cross, but the market holds its shit together for a year, which, as I said, is my base scenario right now. So I'm not expecting the market to V to infinity here. I'm thinking at best it could go sideways for a year, and it heals like this. Also notice that we're still on the right side of this channel over here, this beige downtrend channel. We're on the right side of it. We're not back inside. If we go back inside, then it's going to look like a failed breakout. Right. With falling averages, and that's going to be a nightmare because then you end up coming down to 300, 290, 275. Typically, what happens is if you have a failed breakout, you go to the other side of the channel. So if that happens 2 or 3 months from now, I mean, maybe it doesn't happen like that fast, but we could end up coming down to this. We could retest the floor of this green channel over here. That's currently at 300. If that's 3 months from now, 2 or 3 months from now, then maybe it's at 315, something like that. These numbers down here. So I think that gives us a good idea for if the market tanks, it goes below the 50 MA, then I'm looking at these sort of levels down here as far as the SPY is concerned. And now, clearly, it would be another thing whether they hold or not. If we get there, first of all, whether we get there or not, and then whether we hold there or not. But certainly it gives me an idea to the type of move we could see if we don't hold this support this month. And it's being held together by sticky tape, as you can see, right? Just sitting there. It literally looked like a sticky tape, right? Anyway, let's continue back in time. So then we'll take a look at 2008. And you can see, again, you've got the same structure. So you've got the same downtrend channel here, same downtrend channel in 2020, 22, and this. So I actually started this chart by creating the channel over here. And then I moved it across to see whether it still fit. So again, this shows you how rhythmic the market is and how even downtrends are very similar. Now let's compare this to 2008, because everybody's been doing that for years now. I mean, it's driving me nuts. All the comparisons with 2008. Now, the funny thing is, it might actually become like 2008 in the end. We're not that far away from it, to be honest, right? So if you look at what happened over here, for about 8 or 9 months, we moved between, well, we went below the 9 and the 20. We're somewhere here, right? So you can see, you know, we're below the 9 and the 20, right? And they've rolled over. We're in this space over here where we're above the 50 MA. So what made 2008 become what it did was losing that 50 monthly moving average in this downtrend channel. We first reject the 9 monthly moving average, and as we reject the 9 monthly moving average, we lose the support of the 50 MA. So that's the order in which this will work out. We've already rejected the 9 monthly moving average. Now we've got to hold support above the 50 monthly moving average. If that doesn't happen, then it will begin to look like this, as far as the trends are concerned. And it will look like nothing that we've seen in previous corrections, just by nature of the trends, right? So we'll be below the 50 MA. We haven't seen that with the moving averages looking like this in the last 10 years, right? So then you end up with something that looks potentially like this. And then while we keep rejecting the 9 monthly moving average, prices will crater, and that could take a year. Well, who knows how long it could take? But that would be the benchmark to how long this could last. Is once we cross above the 9 monthly moving average, it'll probably be over. That'll be it. If that lasts a month, 2 months, 3 months, 6 months, 2 years, 10 years, it'll be probably driven by regaining the 9 monthly moving average. If you look at 2008, 2009, once we managed to get back above the 9 MA, then it was probably, that marked the beginning of the end, even though there were decent pullbacks in future years, right? So that would be what I'm looking for. So I mean, in summary, right now, I think the market isn't dead yet. We're still above a 50 monthly moving average. We're holding this pivot over here, and it could change this week. So I'm keeping an open mind to that. Whether I think that's going to happen or not, I mean, honestly, I think it's 50-50. I would be surprised if we just go higher from here. I'm not ruling it out just because of where the charts look, but I will know that it's over if we get above the 9 monthly moving average. Whilst the 9 monthly moving average is still resistance, we've got to be cautious.
It's hard to get super bullish, right? Like it's just difficult because that's serving as the pressure downward.
It is, absolutely. It's pushing price down. So I think the good thing about having the chart set up in this way is the decision is not going to be hard to make because the inputs are very simple. It's just the 9 monthly moving average there, it's the 383 support, and it's the 50 monthly moving average. And between those three levels, I'll be able to gauge whether the market's going to shit the bed, whether it's going to go sideways, or whether it's going to break higher. And that's what we need.
And to just, rehash what you were saying, chopping is still sort of your base case right now. And that can be painful on both ends of the trade, especially for longs and those who get caught on the wrong side of a trade.
Yeah, absolutely. I think what I've been saying to the guys on that I'm trading with each day is we need to be open to the idea that the market doesn't break out and it doesn't break down and it just drives everybody nuts for another year. And if we accept that as a possibility, then we won't be frustrated by it if we see that. And I think one of the difficulties this year in 2022 has been so many people got burned because their expectations weren't really well aligned with what's actually happening. And it's a mental game. It's not just about the money, is it? I mean, everyone's getting burnt mentally because of what the market's done. So I think if we can be prepared.
Well, I think we've definitely seen that right on the post volume that we see on certain tickers on stock twits. I know the activity of our weekly call here on the TA report. People are losing interest because it's just been so difficult to trade, and we've been in this now for 9 months or more.
Right. And I think what's tough is that it's the combination of an algo and options flow driven market with a downturn, because back in 2008 it might have been easy to trade. I mean, I don't know, I wasn't as active back then. I mean, was I trading back then? I might have been, but certainly not as active as I am now. But I'm sure that it might have been an easier market to trade over here and over here, even though you've got that volatility, then what you've got now, I think what we're seeing now with the machines and the algos and stuff is just very, very taxing. It's very hard. It is for many people, for everyone, myself included, for all of us.
So Cookie, one thing that, excuse me, one thing that you had brought up, in our previous call back in June was you were saying that, you expected this to maybe in the Q1 or Q2 of 2023. And, you gave us some low price targets, 220 on the Qs, around 300 on SPY. Right now, just the way your chart's set up, it seems to be that you're still in that camp, but I don't want to presume and put words in your mouth.
Yeah. I mean, as I said, as far as downside targets are concerned, I don't think I have anything different to add. I would just say that I'm just still open to things not going that far. If we hold the lows, if we hold this area, then we go sideways from here. And maybe the lowest we get is, let me show you.
Well, one thing we have going for us, the last time we had, you were almost a perfect bottom call. So maybe we go a little bit higher. We were, before we went live, we were looking like a little bit of a intraday reversal off the highs. And you said you had something about that too. I don't know if you're ready to share what that might have been, but yeah, just interesting.
Yeah, I can share that. Let me just give you a number first of all. So I think this will be the number that we'll need to hold. So this will be the bear flag support, 370. Right, so 370 will need to hold this month. I think if it goes below that, then that's enough wiggle room inside of this channel to then start getting a bit worried. If we go below 370, then it's probably game over. So if we hold 370, I think it's going to be fine. So even down to that level, so that's another 15 points from here. That's another 5%. We could see that, right? But if we go down to there and it holds, I'll end up buying it. We'll see what happens from there, but that's what I think. Let me show you a couple of other charts as well. So this is QQQ on the same thing. Now, see how uncanny it is? You think you've seen it before. It's the same as the SPY chart. So people talk about rotation and stuff, and I say that's bullshit. It's all just one chart. Everything moves on the same chart. And so here is 2A1. That support is 2A1 on the side, on the edge of that channel, and you can see again it's being held together just there. So even though on the surface you'd say, well, QQQ looks weaker than SPY. Well, what I've discovered along the way is, imagine that everything moves along the same structure. Some will outperform others. So let me just share this, and I'll answer the question you asked before. So imagine that SPY is the center line of everything. So it's the benchmark. And then you'll have certain sectors which outperform and other sectors which underperform regularly. So for example, QQQ will outperform both directions. So QQQ will pull back more and it will go up more. XBI will do even worse. It will go all the way up there and it will go all the way down there, but it's the same chart. So what you have is everything moves in the same direction, but certain sectors are more elastic than others. So they'll get stretched in one direction much more than others. And it makes sense when you think about the risk profile of biotech and growth compared to just general S&P. And if you look at other things, so you asked about Soxel, I think, earlier as well. Can I share that quickly?
Yes, please.
The same chart. So you've got Soxel. So this is the same chart again. And this time you can see it looks a little bit different. The structure is the same, but this time you see it breaks out from, so it's a fill breakout on the north side, and then it goes all the way through, and then there's that corresponding breakdown below the green channel. And here, it's also sitting at support. So you asked me, I think one of the questions you wanted to discuss was, are semiconductors dead? Well, semiconductors are at the same decision point as everything else. You can see the support connecting the lows from June, which is the support that connected the COVID lows. It's the same support that connected the lows back in 2015 and the same support that connected 2012. So everything is at the same crossroads. So everything could be saved, including semiconductors. And I'm not going to show you my NVIDIA chart. I'm not going to go through some of the technical, but that also bounced off a support. 261 was my weekly support on NVIDIA net last week, and it bounced to the cent off that. And it's the same as the sector here. So and AMD at 75 is a monthly support, and it bounced there, and it went racing higher today. So I think, I want to keep an open mind to what might come next. I think things could unravel very quickly based on what we're seeing on all of these charts. But right now, I wouldn't be diving into short positions just because we're at support. I mean, it just wouldn't make sense, right? So there's that. And let me just show. I've got all of them. I might as well just share a couple of them here. And there's small caps. There's the Russell 2000. It's the same chart, right? And I don't know. I'm not going to bore you with many more. The worst one, let me show you the worst one, is ARK. Look at that. So that's ARK, which looks like an absolute shit, right? So it breaks out, can you see it? So it travels along the top of the channel, it breaks out, double top, breaks down, goes all the way through. So it breaks out on the north side, it breaks down on the south side, and now it's holding the lower edge of that channel. So others are, maybe fighting to break out or looking on the north side of this beige channel, whereas ARK is on the lower side, but that's still a support. So whether it's on the north side or whether it's on the south side, there's a support there. So even ARK, which looks like a bag of shit, is still supportive, just like everything else is in the market right now. And the interesting thing is different sectors travel different distances to meet their equivalent supports on the same chart. That's what's fascinating about it. I mean, I could drool about the markets, as you know, for like hours on end, but I won't bore you with more of that. What was your question before? Sorry, what was your question?
Oh, the intraday reversal that we were seeing. You said you had you had something for that.
Okay, now it's a bit complicated, but I'm really happy to share it. So if what I do is I always ask myself questions, what if questions, and I try and come up with the answers to those. So if crypto and all the sectors move to the same chart, then I should be able to use any chart to trade anything else, right? That's just logic, because every chart everything will find support, everything will find resistance at the same times. So I could find, for example, a support on ARK and say it's likely that the SPY will find support when ARK hits 39, and it did. So with that type of argument, you could say, well, let's think about crypto. And I am going to answer your question. So this is leading up to that, right?
That's okay, Cookie.
Crypto and stocks are moving in tandem. People have been, talking about debating that whether it's a separate asset and you can't compare it, but that's bullshit, right? They've been moving together since forever, at least since 2000 and since Bitcoin was born. Because I'm able to show that on the same chart here, right? So this is my Bitcoin chart, by the way. Right? And again, you can see it's just a little bit above this support. Now, let me just point this out because I'm here. So Bitcoin, this is an important support. So, this center line here, so this is the lows in 2020. This is the lows in 2015. This is a breakout back in 2013. So you can see that test there, the test there, and then the 3-month bear flag on the same support. So June, July, August, and then September, we break down through it. And we're below the 50-monthly moving average, but we still have 16,000 as a support below. So there's still that little bit of space, breathing room on Bitcoin, but it's below a support that held for the last 7 years. So I think that's very, very important. So if we were to bounce off 16,000, we need to get back above 20,000. Otherwise, it's probably game over. We end up going all the way down to nasty levels on crypto. But as far as Ethereum is concerned, so what I found is the closest match to the S&P is Ethereum. So I can chart Ethereum on a 4-hour time frame or an hourly time frame, and it will be identical to the S&P. And that might seem hard to believe, given
just on a visual representation,
in terms of how the trends are moving.
Got it.
Right, including intraday movements some of the time. Now, I know you've got weekends in crypto, so you could say, well, how do you explain that when the markets are closed and the crypto is open on the weekends? They catch up. It's weird, but they do. They sort of work together, right? And the reason I'm saying this is because sometimes I will find clues in an Ethereum chart that will help me understand how the markets are going to move. Because if they all move together, then every chart can explain everything. Right? As an abstract idea as that might sound, right? So if I could use an Ethereum scenario to try and come up with how the market might move as well, which is what I did. So let me show you this chart. Now, this is a bit weird, right? So this is, I know it's going to look like shit, right?
I love it, Cookie. This is how I use my crayons.
Look, the reason why it looks like shit is because I've removed half the chart. Okay, because you know some of my stuff is top secret, right? You're
Yeah.
supposed to laugh.
Yeah, no, it is. That was serious. That wasn't funny. That's serious. That's serious shit.
So I've removed the top secret elements of it, and I've left what still allows me to explain the story of what's going on in the market right now, right? So let me highlight a couple of the elements here. Right? It's going to be fun, right? So it'll be fun for people who've not done TA like this before to just explain how these things work, right? So there's a top in Ethereum in the middle of August. On the 14th of August, Ethereum topped out over here, and then it traveled down this, what I call the brown pants channel, right? It's actually a little bit orange, but it doesn't matter. Right? So traveled down this brown pants channel, which was hairy. As if you were holding it, then you would have pooped your pants many, many times over, right? And it goes down to here. And because of elements in the background of the chart that you can no longer see, I started seeing the trends looking very similar to what we'd had back in the middle of August. So what did I do? I start copying the elements from August to now. So already back in the day, so already going back, I don't know, a few, 4 or 5 days ago, I added the same channel exactly to this part of the chart, like that. So what this tells me is it gives me an idea to how Ethereum could move given how it's moved in the past. Now, clearly there's no guarantees it's going to do that. Over here, you had what people said was the run up to the merge. Right? So everybody's buying Ethereum because of the run up to the merge. Well, over here, there was something else. What was it? I don't know. I don't know what it was. But whatever excuse people want to use, prices ran higher, right? And then there is an element in the chart that saw price start rejecting this. And it's not this gray rectangle. I put this gray rectangle here to make it easier. All right. But there's something else there, but it doesn't matter. It doesn't really make any difference, right? So over here, you see price start stalling and then the moving averages roll over. And so what this shows me is that Ethereum has moved down in the same amount of time as what it did over here. So it's not the fact that it just moved down, but it did so in the same amount of time. Right? So this is why I'm going to start talking about what could happen in the market this week, because what my charts do is not only talk about price points, but they also help me with timing and scenarios as well in terms of how long things might last, right? How long things might take to play out. So over here, price moves down and you can see every time it hits the bottom of the channel, it travels across, just like over here. It hits the bottom of the channel, it travels across, hits the bottom, travels across. So we were using this chart to manage short positions and say, well, if we find support over here and we cross the center line, then there's a fair chance that we'll get to the other side, because that's what it did over here. So we come up with if statements. If we cross the center line, we're likely to get to the other side, just like over here. And that's what happened. So we shorted at 16. I shorted again at 16.10 or 16.05 the other day, and I took that right down to here, closed my shorts in this area over here, even though prices went lower, because the expectation was that prices could start effing around. So they might not be as clean, and I want to swing a short that's easy, right? And then I day trade this. So I day trade the consolidation. It went lower, and then again it goes to the side. It goes to the other side of the channel, and we took the short over here at 14. Some of the people in the group took the short around 1500 and then rolled it down like this. Now what we see now, where we currently are, is this area of the chart is obviously today, right? So this is where we are right now. So what we looked at was the possibility that the bottom looks the same as this. Because if everything else has looked the same so far, then my going in assumption is, well, it may continue to look the same. Clearly, that's an assumption. It doesn't have to do that. But so far it is. So what we were looking at last Friday was two things. Number one, the market closed on, I've got a similar chart like this for the S&P, for the futures, right? The S&P did this on a Friday. Ethereum did it today, but it ended up at the same place. So even though there's that, difference of 2 days between the charts, they did the same thing. And I found that there were other areas in the chart. So for example, let me see if I have far back with that. Over here, or this period here. So this period here. So the S&P did that, exactly did that. I mean, one of the things I did, and this is just as a side note, right, just to show you how fascinating all this is. So what is I marked that range like that. Okay, I marked that range like that, and then I did the same for the S&P, and it was the same thing. It's exactly the same thing. It's weird, right? And what you find is Ethereum does the same as the S&P, but it's magnified by 3 or 4x. So what you find is that some of these sectors, and going back to what I mentioned earlier, right, it's the same idea. So the XBI will do the same as the S&P, but it's magnified. QQQ will do the same as the S&P, but it's magnified. So you get everything doing the same thing, but they're just more volatile. That's it. I mean, when I say magnified, they just basically mean that they're just a lot more volatile. So anyway, come back to here. Right? If you're losing any of this, and you just tell me to stop, right? But over here, so this is where we currently are. So what I was looking for the market to do this morning was to rush higher, to race higher, because it would be a move, something like this. It's the move from the bottom of the channel back to the 9 MA, back to the 9 MA on the 4-hour chart, which is, and then get to around this 20 for the falling 20 MA, which is what the S&P did as well. So this area here is where we currently are. Now, if this continues to play out, and so far it has been identical to this area over here, then what we were looking at last week, or Friday and of the weekend in my regular Sunday call, was for the market to remain supported till the Fed. This is 2 days. So what happened back in August and that 2-day leg up fits here, just ahead of the Fed. So what I'm thinking is that the market could remain, again, this is just using this scenario, right? It doesn't have to play out. But for it to play out, we need to see the 9 MA begin to rise and price hold the 9 MA on the 4-hour time frame, because then it will look the same. So far, it hasn't done that yet. But if you look here, it took days for that to happen, for this bottom to form. So it might not happen until maybe tomorrow morning or something. So it's trying to form this bottom here at the same place as it did back in August. And then we get that run higher to around the 4-hour 50 MA, and then it tanks. Okay, and it tanks, and what it does is it meets the same channel. It meets the same channel 2 or 3 days later. So that tank, it comes down to here. And that's why I've drawn these parallel lines to mark where price could end up going in the future, right, like that. So if we were to get that run higher, we will end up coming back to meet that as a back test to begin with, and then possibly go sideways. So this is what I'm thinking about as far as what the market could do, right? Let me see if I can, well, I can't draw it on here, right? So possibly a run higher to this area around 1450. I think that'll be as high as we get. And then it tanks down to here. So we end up down to around 1245. This area here. There's a beautiful cross here. It's at the lower end of this green range, which I've already marked from before. Right, so we end up down to here, so around this 1245 area. So we end up going higher, then down to here, and then we see what happens next. So my guess is, after we've gone through this, given that the weekly time frame will look like shit and the monthly time frame will look even worse, how likely is it that we then go sideways after this? If we end up doing what I said, what could happen, like we go higher, like a little run up for a couple of days and then tank after that, then it's possible that it doesn't stop here. So that would be certainly a bearish outcome for Ethereum and crypto. We've seen how Bitcoin is barely hanging on. It's below the 50 monthly moving average. It's below support that connects 2013 and 2020. So so there's that possibility we've got to be open to, right? Can I end with one small thing?
You
and
can.
Then I'll hand over. So that's the bearish case, right? So this is around 1250. So now let me share this with you right now. Oh, it's not there, it's here. So this is the same chart that I mentioned earlier. Right? So I've got the same chart on XBI, Soxel, all of those that I mentioned earlier, right? So this is the same chart for Ethereum, but I've marked it up with additional elements. Now, some of you might remember, I mean, I don't know if you knew me, or did you know me back in 2017?
No.
Okay, right. So in 2017, we were here. Right now, this is a monthly chart, and it just looks like a little zit, little pimple on the side of the chart. But back in 2017, Ethereum went from $5 all the way to, well, it went from 5 to 20, it came down, and then it raced higher to like 800. So it did this, and this was the bull market in 2017. Now, this big shape that you see here, this diamond, or this, what do you call that? It's a rhombus, isn't it? I guess.
Sounds good. I didn't do great in geometry.
Okay, it's a parallelogram, right?
Parallelogram.
Right, nice one. Thanks, Jimmy. So I don't have the chart open, unfortunately, but in 2017, it did this. It did exactly this, but it didn't do it on the monthly time frame. It did this on the daily time frame. So if you imagine each of these candles were daily candles, Ethereum did this during 2017, and at the end of 2017, it went vertical like that. So what I'm trying to say is this structure here is identical to the structure in 2017 before it went bonkers like that. And what I remember saying in 2018 was, it's possible that crypto repeats the same structures and the same cycles, but rather than doing them on the daily time frame, it'll go on to do them on the weekly and the monthly time frame. And I said that in 2018. So when I looked at this chart, when I created this chart a month or so ago, and I looked at it again just a few days ago, in my mind was this idea of this fractal, of this parallelogram back in 2017. And I can post it later because I do have the chart. I can post it if you want to take a look, you can compare. So it did exactly that. So then I completed, because you can see here now, let me change the color because it's a bit bright. It's hard to see. Let me change it to something a bit less worry, right? So you can see that move up, down. So you get the failed breakout. It goes to the other side of the wedge, right? Because it's a wedge at this stage, right? It goes back to the top. You get the failed breakouts. You see the moving average rolling over just over there, and we go back to here, back to the lower edge. And you can see, so even though Bitcoin has broken that support, Ethereum hasn't yet done so. And when you think about what happened with Ethereum back in August, all of this, all of this strength. And then it tanked like crazy, right? So if you go back, it came all the way down from like 2000, it went down to 1,000. So all of these moves in Ethereum were part of building this structure. Were this, actually, with that massive tank down to here. And, Ethereum did that. Nothing else did. Nothing was as bad. Ethereum went, it was way worse than many of the altcoins. But it is respect of this shape, at least for now. So right now, as far as this chart is concerned, and this is the glass half full picture. Remember what I said about the 4-hour chart, which is still here somewhere, is that 1250 area, this cross over here. So we go higher, we come down to this 1250 area over here, which miraculously is that support over here, 1230, 1220, this area over here. So what this tells me then is looking at both the short term and the long term together, right? So short term, there's that possibility that the market pushes high, it still breaks down, and we test 1220 between now and the end of the month, maybe this week, right? It's possible. If we were to hold 1220, this would be the same as all of these other sectors holding support. Because if Ethereum holds support, everything will. They will all do it together because it's the same chart. And so what you end up then with is a much more rosy picture. Not fabulous, but it's better than the market going like 2008, is what you end up with is Ethereum consolidates in this space. So this ends up becoming a consolidation as it gets tighter over here, but it's rising. So we see 1,200 as the lows, and we go higher from here. So it might not break out straight away, and it could take 2 years to fill this space. This space ends in September
2024. Right.
That's 2 years. And so we end up doing the same as what we did in 2017, but on a monthly time frame. And it takes 2 years to get there. And we'll be at 6,000 in 2 years, 7,000 in 2 years, which is reasonable when you consider what's going on. Some people might say that's outrageous. How can you say, with the market and the interest rates and the war in Ukraine, all that stuff, how can you get Ethereum at 7,000? But I'm saying 2 years from now, it could be there. Now, clearly, we need to hold this support. We need to see that holding, what was it, 1220 or so, right? We hold it, and if you don't have the number, just remember the 50-monthly moving average, because it's the same thing. And it's not coincidental that the moving averages line up with a channel support as well. And you'll find that if you do a lot of charts, that the moving averages tend to give you similar numbers, right? So the 50-monthly moving average is key for Ethereum to hold this month. And if it does, then maybe the market holds its shit together. Every market holds its shit together. XBI does, Soxel does, small caps do, all of it does. And what we see is the market going sideways for 2 years. But as far as crypto is concerned, it means it grinds higher. It grinds a little bit higher. So, that's 1,500 at the end of the year. So we're not talking monster rallies here, right? So the base support is 1,500. It goes up to 2,000 by the middle of next year. Right, but we could see the odd rally inside there. So maybe it goes back to 2,000 along the way, 2,500. But as long as it holds this, then it will look like what it did back in 2017 as a precursor to the monster rally that we had at the end of 2017. or sorry, when is this? This is end of 2016 to early 2017, right? So this 4 months, which would be this. So if crypto doesn't die and this plays out like it did in 2016, 17, then it goes from 7,000, and this is where you all scoff and you all laugh, it goes to 70,000. Well, I don't know if it's going to go that high, but it ends up dying along the way somewhere, but an insane number, right? And that will be, something
orders
like,
of magnitude there.
right, but the thing is, it's done that before. So let me just show you here. Right? So if we go price range, right? So price range. So what was this move over here? It was 12,000%. Some fucking stupid number like that. So here, it will be the same thing because it's all log, right? So there's 10,000%. So this is where, crypto comes of age. And so if you then start thinking a little bit more as far as the environment and macro is concerned, you start thinking about, well, if this does this, then growth does that, and biotech does that, and AI does that, and 3D printing does that, everything does that. And this would be the sort of time horizon that it could take for self-driving cars, for crypto to come on stream, for Bitcoin to become mainstream, and all that sort of stuff. And so then you start saying, well, maybe this is when you start seeing true adoption in all of these different sectors. So we go from 7,000 to 50, 60,000 in Ethereum, which wouldn't be unrealistic, could go to 100,000. So what everybody's been talking about Bitcoin doing now, maybe it wasn't ever going to do until 2025. And that will be the time when all of these different technologies maybe find their light of day. And maybe during the next 2 years is a period of accumulation, right? And it's, markets going sideways, maybe a little bit depressing. But if we have an idea to what the future might look like, and remember, one of the things I say to the guys that I trade with is, interest rates will go up and down, inflation will go up and down, but innovation will continue. And eventually that stuff will find the light of day. And there will be a market for it. There will be consumers who buy it. And if that's the case, and it will be the case, then prices will go high eventually. So, maybe it's becoming a bit of an
I have a question for you, Cookie. That's like, I agree that innovation will take over at some point, and it took 14 years from 2000 to 2014 for that innovation to kind of play out, the internet innovation. So, like, what makes you think it's 2 years outside of the charts, based, like, you're thinking faster adoption to stuff than we've done before? And a lot of the innovation took place when I think it was Amazon that launched AWS, and which ultimately set the basis for Microsoft and Google Cloud, which then helped these guys get to massive moments. Right. And that was about 14 years. So what makes you think it's 2 years versus that longer period?
It's something that I call compound innovation, right? Which basically means innovation happens on the shoulders of other innovation that's already happened. So if you look around at crypto, it's not happening before the internet, it's happening after the internet, it's happening after 4-nanometer chips, it's happening after all of these other things which are coming online. So if you think about, why innovation should get faster, that's the reason. And it's compounding every time. So every cycle is compounding the previous cycle. It's not like Bitcoin is being launched to cavemen. So it shouldn't take 14 years every time. It should get smaller and smaller. It should get less and less time. It should do. And there's a very real example. I can give you a very real example of that. How long does it take companies to reach $1 billion or to generate $1 billion in revenue?
Much less time.
Much less time. How long does it take a company to reach a Fortune 500 size company? How long did it take Facebook to get there? How long did it take Coca-Cola to get there, or Procter & Gamble? I mean, everything's getting faster and faster. And one example I could share with you is if you look at Binance in the space of crypto specifically, right? They generated $1 billion in revenue in their first year of existence. How the fuck does that happen?
To me, just because there's obviously a ton of money supply that's come in, so the $1 billion is more like $1 million, right, or $100 million from. Right, but it's
compounding. They're able to but you're missing the point. They're able to create a business that generates $1 billion in a year. How long would it have taken to create a business 20 years ago that generates $1 billion in profit? the thing is, the businesses are very different today compared to what they were 20 years ago. It's all online.
Yeah, absolutely.
So that's my point. So you can't compare how tough it was for Amazon to create that business it did 20 years ago to blockchain companies creating businesses today with the advantages they've got.
That's the thing. It wasn't Amazon's bookstore that launched it into the stratosphere. It was the 15-year mark where they launched AWS, right? That was their maturity that took them to the next level.
Right. But network effect.
Yeah.
And speed of, network effect, compound innovation, all of this, reaching 1 billion consumers today that you couldn't do 20 years ago. So, the reason why Amazon is doing really well is because it has that reach today. Why Netflix is doing well, it has that reach today, right? And any company could theoretically reach 1 billion people today, launching today much faster than they ever could have done in the past because of the technology that's available to them today, right?
Yeah.
And
absolutely. Sorry, guys, I gotta sign off. Enjoy the rest of the call.
Yeah, thanks, GP.
All right. Okay.
Hey, Cookie. So let me rephrase my questions to you then. So I asked about a potential of crypto winner, and we've used Bitcoin in the past as risk on, risk off indicator. And from what you've just displayed, and again, I don't want to put words in your mouth, so correct me if I'm wrong. Ethereum is acting as the market tail to some degree. You're watching it as a leader. You're not saying that things couldn't break down because we're living on the edge. But if Ethereum is living up to your hypothesis as being the potential leader of the markets in general, we could have a couple years of trading sideways, regardless of what happens with Bitcoin and how that is positioned as a risk on or risk off. Because if we look at that trend line, that's a pretty big delta, right? From 2620 down to roughly, I guess it's around 1350 right now. So there still can be a lot of trading in that range, in that grind up. But by no means do you think it's over for Ethereum to basically show us the way in which the market's going to go?
Yeah, I mean, if I can just, basically, yeah, but let me just refine that a little bit.
Yeah, please.
I'm using Ethereum as a guide to what the markets could do, but I could have used any chart. Going back to what I said earlier, I could find scenarios which would match on any of the charts. Happen to develop them on the Ethereum chart. So I could do something like this for Tesla, for example. So similar type of, we talk about innovation and tech and stuff, and then probably find something very similar, right? So I just happen to find a pattern that could repeat again. It doesn't have to play out, right? So I mean, I think there's an important assumption here that this could repeat the same as it did in 2017. Now, there's clearly no guarantee of that. And if we don't hold this support, if we don't hold this at 1200 support, then maybe my things disappeared. Here we go. It could go all the way down to maybe $100 or $50. I mean, it could go there. Again, I'm not ruling anything.
Yeah. We're not taking the shit the bed scenario off the table here. But right now, and again, it's an assumption that Ethereum could be a key to the way the other markets move, maybe as long as up to 2 years.
It could be, yeah, it could be, and but also let's not forget that point that I made, that all of the charts are showing the same thing. So
yes.
For Ethereum, it's 1220. For Soxel, it's 1138.
Yes,
it's the same thing. And I could draw that wedge shape and funny shapes on the Soxel chart. I could develop this chart to show you a similar outcome. But it's the 1138 support here on ARC. It's the 3930 support here on XBI. It's another support. Actually, it's all the way down to 72. It would be fine.
Maybe the way I should say that, and again, feel free to jump in and correct me. Ethereum is probably a very good display of what could happen as compared to the other charts.
I think so, and also just it's nice to see prices are being supported over here. I would just say as well that look, we are going to have problems in the world. Right? And problems aren't going to go away. We're always going to have difficulties. There's going to be recessions and there's going to be peaks and troughs and stuff, but life will go on, right? And I think, we tend to forget that, because we're surrounded by doom, especially as traders. We're honed into the stories that we hear in media all the time. And when you do that, you think there's nothing out there. There's nothing for me, and the world is going to end, and the innovation isn't going to happen. Self-driving cars are going to come online, and this isn't going to happen. All of it will come. All of it will happen. It's just a question of time. And when you accept that, then you say, well, how am I going to deal with that as a trader / investor? If you're going to trade, then it helps obviously to know what the market might look like in the near midterm. If you're an investor, then maybe you're not as gloomy as you might have been if you're just exposed to all the media out there. So that's really my take. That's really where I'm coming.
All right. Well, we've talked a lot about of the base scenario, which is mine as well, is that we could absolutely grind sideways for an indetermined, indefinite amount of time. It will correct itself and make a decision at one point or the other. We've covered downside. Let's talk the upside. I think you gave me a scenario where there could be an upside surprise. It's not your base scenario. It's probably maybe a lower percentage chance than the downward case scenario, but there is an up case scenario. So if you don't mind, give us a minute or two on that.
So here's where I think we could get, right? So if the market grinded sideways, I think we'd end up with something like this. Probably something like that.
Yep.
Now that stretches all the way to 2024. So you're looking at somewhere, so the lower bound being the 50 monthly moving average, and the upper bound being around the 20 monthly moving average, just coming around 440. So between 365 and 430 for the next 2 years. And it will end up looking something like 2016, right? So let me just draw a rectangle. Well, actually 2016 did this. So it was a little worse, actually. That's sideways. So if you want to be more purist, then you say, well, maybe it looks something like that. So maybe a little bit wider. Right, maybe we get wider ranges like that, but not too different to that. So that would be, being, not too optimistic, but something along those lines.
That's not the going to zero crowd, but that's not optimistic, right?
Right. And I think that we could see that. So you see the 50 monthly moving average coming in from below, and it's squeezing prices. So you end up with, I can't draw. Let me see. Oh, maybe I can. So let me draw. So a projection of the 9 MA will be like that, right? So we can guess what could come next. So that would be the 9 MA coming down. You've got the 50 MA going in this fashion like that. Because the 50 MA will take a long. If prices don't die, right, and the 50 MA will continue to flatten out, or in this area over here, then this will give us a space for the market then to decide where it's going to go. So we're looking at the middle of next year. Right, so around May, June of next year, where either we're going to break above the 9 monthly moving average, or we break down below the 50 monthly moving average. So it's going to be one of those two things. It can't be anything else. It's either you have to break above the 9 MA, or we break down below the 50 MA. So that gives us a window of about 8 or 9 months, assuming that we don't just time below right now, right? So 8 or 9 months of possible grind sideways, which isn't that bad, considering, right? And it will look something like this area over here. I guess. Does that help?
Yeah.
I mean, and the good thing about having, thinking things through logically like this is it helps set expectations which are realistic, and it then helps you to decide how and when you want to trade. Because the last thing you want to do is be losing money in a market that goes sideways, right? And you get overly bearish and ends up bouncing, which is what's happened over the last 6 months. So
yeah, and I think a lot of traders who've recently been doing this over the past couple of years, they're used to what happened in 2020, right? I mean, that was and really most of 2021, that was an amazing ride higher, but you don't always get that, and to expect that prices are only going to do that, is a fool's errand. Over the course of time, the markets go higher, but in any certain period of time, you can have drawdowns. You can have periods of going sideways or grinding up or grinding down. And no, I think that's an extremely realistic view of what it could be, right? I think that's around 440, probably the top of that range box. And if that happened, that doesn't mean it can't break out of said range box at some point in time. But that's sort of a good eyeball right there of, all right, here's a pretty good estimate of, maybe what to expect on the S&P over the next year and a half.
Yeah, there you go. So July 2023.
Yeah.
That's like, that gives me the end point of that wedge. And again, my job here, my role isn't to forecast with a crystal ball what's going to happen in the markets. It's to come up with realistic scenarios based on simple logic. And I think most of the time, what we do as traders is we overthink stuff, and we think too extremely. If that makes sense. We rush to extreme. We're going to go to all-time highs, and we're going to go to zero, like you said, right? But it's never that easy. It's never that simple. And even if we were going to go to zero, or even if we were going to go to all-time highs, it's not going to be in a straight F. It's not going to be in a straight effing line anyway. And I think a lot of the young traders today, the reason why they get so burnt and frustrated is because the market shafts everybody most of the time because it doesn't. Sorry, that's a very slang English word.
No.
It doesn't move how everybody wants it to. And I think one of the reasons why I do all of this stuff, like we looked at earlier, was to try and do this 4D chess of trying to understand how the markets are going to move. Well, so just to frame it, so I'll start with the big picture, the monthly and the weekly timeframes, and then I will go down into the detail to see how it might move on a daily and even on a 4-hourly basis. Now, ultimately, I will trade based on trend. So what this chart is aimed at doing is to help me to forecast the trend. So I'm actually trying to forecast the trend by looking at similar trends in the past. So what I do is I always look at how, I look at periods in the past where where the moving averages look the same. And that becomes my starting point for trying to estimate what the trends might do in the future. Because if they look like this in the past, which they did, then they might move like they did in the past over here. So this is great because it allows us to, we still follow the rules of, of trading trends as we see them, but by forecasting how they might move, then it just gives that little bit more of an edge, I would say. That's what I'm trying to do here.
Yeah, absolutely, Cookie. And, I think the world of you. I know it's very early or late, depending on what depending on what you're doing. It's either early or late. So I won't keep you too much longer. I do have one additional piece for you. Just curious as what your take is. And again, this is all you've said, the charts are the same. What I'm seeing is, we've seen in the markets, oil had a tremendous run up, right? And energy had a tremendous run up, and it would feel like they are breaking down. And when you have multiple things on your charts breaking down, to me, that seems as a more bearish scenario is likely. But again, just wanted your take on what the energy sector has done and the way it's currently positioned.
Okay. Let me share one chart, one of my fancy charts. Let me get CL. This is my oil chart. It's weird because it went to minus something, didn't it? Or went to zero back in the day. So this is my oil chart. So I'm happy to share one.
Thank you.
So my model for oil was that it was going to top the same way as it did in 2018, which was this period over here. So I drew this chart actually months ago. So I drew this chart several months ago, and what you're seeing is, let me just explain it. Right? So what this structure does is it shows you where my pivots come from. Right? So you're seeing all of these different numbers on these shapes here. What they're doing is they're giving me what would be a measured move on a breakdown and a measured move on a breakout at any given moment in time. So without heads and shoulders and cups and saucers and flying heads and all that stuff, I'm able to see measured moves on a breakout and a breakdown at any given moment in time based on where price is. So right now, so this is 2018. So what happened in 2018 was the market hit this downtrend line, which is the same downtrend line as we've got here in 2022, right? So what I was looking for was when oil first peaked back in March at 120 something, for it to come back and retest that line the same way as it did in this area over here. It came down, then it retested that line, right? And then what does it just grinds away in one floor, right? In one, I call these floors, right? So in this one space, right? So from this would be the baseline, and this would be that resistance. So what I'm looking for oil to do is to hold between probably 69 and 90, like it did in this period over here. So far, oil is topping in the same way as it did back in 2018. So there was a major run up to that point. There was a major run up to the same point. And then it pulls back, and then it grinds away for a year. It grinds away for a year. So, and it does this, the moving averages start rolling over. And then eventually that leads to a breakdown. It led to that breakdown, but that was COVID. So that was very unique. So, anybody's guess whether we get something like a COVID again in the future, right? So certainly, what happened back in 2018 was if you discount COVID, then oil found a range and it stayed there for a long time. It stayed there from December 2008. Sorry, that's it is December 2018 all the way to December 2019 for a whole year, and they could do the same over here. So what I'm looking at oil doing is that. So let me just highlight it. Is to stay in this sort of area, possibly like that, something like that, and it could go higher. It might do. But something like this. Now, the difference between this area in the chart and over here is it's a little steeper over here. So you could see prices going a little bit higher. Now, this chart has worked despite the geopolitical noise out there. So with the Ukraine war and everything else, and Russia and Saudis and all the rest of it, right? So it follows the same idea as it did in 2018. So to answer your question in a roundabout sort of way, even though oil looks weak over here, and remember, it looked weak over here as well. It's playing out the same way. So it ends up coming down to here, which could be around 69 over here. So it ends up with a two-floor move, right? So one of the things that these charts give me is symmetry in price. So you see there's an exactly two-floor move over there. We could get a two-floor move down to 70 in oil. And then it goes sideways, possibly for a year, or it ranges between 69 and 90 until the end of 2023. Now, if oil did that, then that would support the argument of the markets going sideways for a year.
Yep.
Going back to what you were asking earlier, right? If oil is, if it's a week, then how does that correlate with the markets holding their shit together? Well, maybe I'm seeing oil also go sideways.
Well, and I brought it up partly because of our last conversation of where's there to hide. And, if you got into the energy sector or oils in late 2021 or early 2022, your portfolio has done okay, right? And with the recent weakness being over the last couple months, if oil's dying, usually tech and growth take off in that scenario as far as like market cyclicality. So if oil or energy were coming down, but at the same time, tech and the S&P and everything else in it is hanging on by a thread, it was bringing me back to my question of where is there to hide? But under this scenario, by this chart, oil could absolutely tread water and basically hold a large swath of the market with it.
They could. And well, the thing is, we're also tied up with what's going on today and this month and last month, but we failed to realize that oil has been going sideways for years. Look at this band that it's in. Right, so apart from the, clearly there's been breakdowns along the way, right? But it's been in this area of the chart since 2007. Right, so clearly there's been mishaps along the way, but you can see it held this range for years. From 2009 to 2013, it was there, and it was again supported by the 50 monthly moving average and the flat 9 and 20 monthly moving average. So that's why I drew these lines here. So you see the 9 rolling over here, the 50 rising slowly, let's say like that, and it supports a range like that. So you'll end up with the 9 MA being resistance, the 50 MA being support, which is rising anyway. So you end up with oil in this sort of range over here, which might be the sweet spot for all the producers. Who knows? But it's not going to be an accident. This is all so well organized and coordinated. You'd be surprised, right? I'm so incredulous after this stuff. I just don't believe any of it's random at all. But holding around 70 will be holding a breakout above this peak as well. So you could say, well, maybe it's just a retest of that breakout above this area over here. So you end up coming back to the same conclusion. We end up ranging between 70 and 90. Or 90 for the next year or so, and that would be fantastic for everything, right? Because remember, the US makes a lot of money from oil.
Yep.
So if oil is supported between 60 and 90, that's good. That's a good thing for the economy. As long as it's not like 110 and $120, oil between 70 and 90 is probably good for the US economy anyway.
Yeah, I would say that's a sweet spot.
Right. So I wouldn't be surprised to see it held back.
Well, Cookie, thank you so much for your time. I want to be cognizant of that, and I appreciate you hopping on. We seem to time these quarterly, and I really appreciate it. Sorry for my voice and being a little bit under the weather, but I'm glad you stopped in, joined us. I'm sorry it didn't work out with GP to stay the whole time, and Nick. But I'm sure they'll go back and watch. Thanks to everybody in the chat. Thanks for everybody for watching.